When it comes to raising funds by a private limited company, the general perception is that there are only two ways of raising funds. One is by way of equity and one is by way of bank finance. What if I tell you that there are more beneficial ways of raising funds by a private limited company? In this video, I'm going to be talking about these other options where you can raise funds for your private limited company more efficiently. Hi, I'm Yashwan Nijgal, a chartered accountant in practice. Every week, I post one video which will certainly provide you with valuable financial insights. The first option would be a CCPS or compulsorily convertible preference shares. Now, one may ask, what is the main difference between equity shares and CCPS? Let me tell you the advantages it has from an investor's point of view and also from the company's point of view. Now, from the investor's point of view, the CCPS or preference shares will have preference over the equity shares at the time of liquidation of the company. This means that in the event the company gets into a loss mode, the preference shareholders will have to be paid before the equity shareholders, and this makes it less risky for the investors. Now, from the company's point of view, say for example, your company needs 1 crore in funds right now, and you issue preference shares to raise these funds. You don't have to dilute the equity of your company immediately, and you can set a timeline, say 2 to 3 years later on, and convert these preference shares to equity shares at a value which can be determined after 2 to 3 years. This way, the extent of dilution by the promoters gets reduced, and it is win-win for both investors and the company. The second interesting option would be debentures. Debentures could be both convertible or non-convertible. Now, from a company point of view, the advantage is there will be no dilution on part of the promoters of the company in terms of equity, and for the investors, it is a much more secured way to give out loans because debentures take priority over both preference shares and equity shares at the time of repayment of debt of the company. Third option, and a much more well-known option, is issue of equity shares. So the advantage from the company's point of view is there will not be any need to pay interest or any kind of return unless and until the company makes money, unlike a debenture. This would also mean that the idea of the startup is being validated because an investor is willing to put money by way of infusion of capital. From an investor's point of view, there are two main advantages. One is that they are entitled to capital appreciation, and this is the main advantage. And second is that they are also entitled to voting rights in the company, which is not available usually in preference shares and definitely not available in the case of debentures. And the fourth option would be by way of raising loans from either banking and financial institutions or by private lenders. The biggest downside for the company would be that there would be periodic repayment of EMI, which would include both interest and principal, and this could definitely hamper the working capital requirement of the company. And the advantage for private lenders is that they can enjoy a higher interest charge-out rate to these companies, and in the event of liquidation, they take precedence over equity shareholders and preference shareholders of the company. So to decide on what would be the right and most appropriate way to fund your company, you will have to understand what exactly your funding requirements are. For example, if you need a temporary working capital for your company just to manage your show for 1 year, I think it would be best if you're able to go with a more debt-oriented instrument such as loan or debentures. But on the other hand, if you feel that for taking your company to the next level, you will need support from the investors in the form of infusion of funds every now and then, I think you can look at having preference shares or equity shares as an instrument for raising funds. And as always, no tricks, no hacks. Follow me for valuable financial insights.